All right, today we are tearing apart the anatomy of a massive stock spike. We're going to look at a company called Brand Engagement Network, ticker BNAI, and what happened on one single, absolutely chaotic day of trading. This story tells you pretty much everything you need to know about the wild world of penny stocks. 478 million. Seriously, just let that number sink in. For a huge blue chip company, that's a pretty busy day. But for a tiny penny stock, that is an absolute feeding frenzy. We're talking more than 25 times its usual daily volume, all crammed into just a few hours. Insane. So the big question is, what on earth just happened here? Was this some kind of huge breakthrough for the company? Or was it just another flash in the pan, a bit of market madness that disappears as quickly as it came? Well, that's exactly what we're here to figure out. Okay, so on November 10th, BNI went on a ride that would make most roller coasters look tame. The stock just skyrocketed to a high of almost 85 cents. But, and trust me, this is a huge but, it couldn't hang on. By the end of the day, it actually closed down 18% from where it started. That right there is a textbook sign of some serious volatility. Now, if you've been around the block with these smaller speculative stocks, this pattern is going to look super familiar. The report we're digging into calls it a pump and pullback. And it's exactly what it sounds like. The pump is that crazy fast surge in price, driven by hype and a ton of volume. And then comes the pullback. That's the sharp reversal when the early birds cash out, take their profits, and often leave the folks who jumped in late holding the bag. To really get what happened on November 10th, we can't just look at that one day in a vacuum. No. We have to hit rewind and see what was happening in the months leading up to it, because this story was building for a while before the fireworks really went off. So check this timeline out. You can literally see the pressure building. Back in September, everything was sleepy, the stock was just kind of drifting along. Then, boom, October 7th. You get what looks like a warning shot, a pretty big spike on some heavy volume. It didn't stick, but it showed what was possible. Then the stock pulls back in early November, almost like a spring coiling up, right? Right before that massive explosion on the 10th. Okay, now we get to the real heart of it all, the technical signals. This is where we try to read the tea leaves and make some sense of all this chaos. And what the data shows us is, well, it's a fascinating puzzle, just a total mix of conflicting clues. The core of the whole thing is this, a technical tug-of-war. On one side, you have these incredibly powerful bullish momentum signals just screaming that this upward trend is the real deal. But on the other side, you've got these bearish exhaustion signals that are waving a red flag, warning that this thing is dangerously overheated and is probably due for a serious cool down. And here's the battlefield laid bare. In the bull corner, you've got signs of a strong trend. Buyers piling in, everything looks great. But in the bear corner, man, the warning lights are flashing bright red. We're seeing classic sell signals, and other indicators are yelling that the stock is overbought. Basically, that it's gone way too far, way too fast. So what in the world does overbought actually mean? Well, think of it like this. Picture a car's engine, and the tachometer is just screaming deep in the red zone. Yeah, it's putting out a ton of power, a huge burst of speed. But it's not sustainable. It just can't stay there forever. Sooner or later, that engine has to cool down. And that's exactly what these signals are saying about BNA. So this tug of war, this conflict in the data, it leads us to a fork in the road. There are two very different potential futures for this stock. Let's break down the bull case versus the bear case. Really, it all boils down to a couple of key price levels. Think of resistance as a ceiling that the stock is trying to punch through, and support as the floor that's holding it up. So in the bull scenario, the buyers get hyped, they smash right through that ceiling around 72 cents, but in the bear scenario, the floor at 46 cents just gives way, and the stock could tumble right back to where it started. So given this high-stakes showdown between the bulls and the bears, what's the final verdict from the analysis? What's the actionable takeaway for somebody looking at this chart thinking, what do I do? The report's conclusion is pretty clear. This is a high-risk, speculative game. The suggestion for anyone feeling bold is to maybe think about buying if the price dips back to that 46-cent support level. But, and this is absolutely critical, they say to use a tight stop loss. That's just an automatic sell order you place right below 40 cents, so if the trade goes wrong, you cap your losses and get out fast. The analysis even puts a number on it, a risk-to-reward ratio of 0.45. So what does that mean in plain English? Well, it suggests that for every dollar you're risking if things go south, the potential reward, if you're right, is calculated to be more than double that. So yeah, it's a gamble, but one where the math suggests the potential upside is bigger than the downside. Okay, but we gotta be super clear about the warnings that come with this. This is only a technical analysis. It says absolutely nothing about the company's actual business. Also, penny stocks are incredibly risky. These kinds of spikes have a long history of fading out fast. And of course, this is not financial advice. Always gotta say that. So when you pull it all apart, the anatomy of this spike shows a classic high-risk gamble. You've got this powerful, raging trend going head-to-head with some really clear signs of exhaustion. All the data is on the table, pointing to a moment of pure speculation. The only question left is, who's willing to play?